So we have discussed how the plan assets and the plan obligations are reconciled. Now the important thing that we actually need to discuss is within the plan obligations there is something that we did discuss, and that was termed as service cost. Now we need to discuss and understand what exactly is a service cost. So when I talk about the concept of service cost, the service cost is actually made up of three things. What are these three things that it is made up of? One of them is considered to be the current service cost. The other one of them is considered to be the past service cost. And the third one of them is called the gain or loss on curtailment. The gain or loss on curtailment. So when we talk about the service cost, it is actually made up of these three things, which is current service cost, the past service cost, and the third one of them is gain or loss on curtailment. Now what exactly do we mean by this? So if I talk about the current service cost, what is the current service cost? The current service cost is actually current service cost is the increase in benefits. It's an increase in present value of benefits payable for employee services in current period. Take an example of gratuity. Say for example, you are seeing final salary into number of years of service. So if the employee serves you for 1 year, that means he is eligible for more benefits. If he is eligible for more benefits, so what is it going to be termed as? That additional benefit to which he is eligible for because of his services in the current period, that is going to be termed as current service cost. So one of them is a current service cost. The second one of them is termed as past service cost. What's a past service cost? So past service cost is actually an increase or decrease in benefits payable to employee for their services in prior periods but arises in current year only. So if there is an increase or a decrease in the benefits payable for the previous services of the employee, but that increase or decrease arises in the current year only, so such is going to be considered as a past service cost. For example, you were giving an employee final salary into number of years of service into 4/5. So if an employee who had worked for, let's say, who is expected to have a 10,000 as a final salary, has worked for 10 years, multiply 4/5 gives you 80,000. Now similarly, if you bring about a change to this formula, maybe you say not 4/5, but it is rather now going to be 4/6. So ultimately the benefits which are going to be payable that are actually going to be payable is 66,667. So if the benefits that are going to be payable are 66,667, the difference which is arising, because originally it was 80,000, the previous service was eligible for benefit of 80,000, now it's eligible for benefit of 66,667, minus 80,000 gives you 13,333, and this is a decrease in the benefit payable, and it is going to be termed as past service cost. It's a decrease in the benefits payable, it would be termed as past service cost. So what is it? Past service cost is increase or decrease in benefits payable for what? Prior periods. But it arises in the current period. So that is what the past service cost is going to be all about. Now let's move a bit forward, let's discuss further. The third one of them is a gain or loss on curtailment. Now what exactly do we mean by gain or loss on curtailment? Try to understand this. What is curtailment? Curtailment is actually reduction in benefits payable to employees for their services due to plan amendment or reduction. Now see, try to understand. I had 500 employees and they were all eligible for gratuity. Now I need to get rid of major portion of employees. I don't want them to be eligible for gratuity. So maybe only 50 employees are eligible for gratuity now. So if only 50 employees are eligible for gratuity, try to understand this. If only 50 employees are eligible for gratuity, what does it mean? It would actually mean that I will now be reducing the benefits payable to these 450 employees. So if I am going to be reducing the benefits payable to these 450 employees, this is going to be termed as curtailment. Curtail, to curtail the benefits payable. Now, when it comes to this curtailment, try to understand. When it comes to curtailment, obviously what is going to happen is there is going to be either a gain or a loss which is going to arise because of this curtailment. What is the gain? What is the loss that would arise? So you see, assume that the present value of defined benefit obligation pertaining to these employees whose benefits have been curtailed was 700 million recognized in our balance sheet or recognized in our fund. And we have settled them with a plan assets of, let's say, 450 million. So hence, resultingly what happens is there is going to be a 250 million which is going to be a gain. There is going to be 250 million which is going to be a gain. But if these employees were being settled and if you would have paid 730 million to them, so resultingly it would have been a 30 million loss. So gain or loss on curtailment. What exactly do you mean by gain or loss on curtailment? The gain or loss on curtailment would actually mean what? The gain or loss on curtailment is that once you curtail, once you reduce the number of employees covered by a plan, or you reduce the benefits payable to employees because of for the plan, once you reduce them, so resultingly this is called a curtailment, and there could be a gain, there could be a loss that could arise on this curtailment. So basically what have we done? We have discussed about three things, which is the service cost is made up of current service cost, which is increase in benefits for current period service, past service cost, increase or decrease of benefits for prior service, and the third one of them is gain or loss on curtailment. Now, another important concept which you need to understand is the assumption of timings for payments to and from fund. You see, just have a quick recall of plan assets. There are 3-4 things that arise with respect to plan asset. One of them is benefit paid, contributions paid. With respect to the plan obligation, you can have service costs, benefits paid, etc., etc. Now, the general assumption, if nothing is mentioned, the general assumption is that all these events arise on the last day of the year or the period. What do you mean by this? That means if you are talking about the year ended December 2021, then all the benefits that are paid out of the fund are paid on 31st December. All the contributions paid into the fund are paid on 31st December. Any service cost is being established on 31st December. Any past service cost that is arising is on 31st December. Any curtailment that's being done is on 31st. So assumption is that everything happens at the end of the year. Just in case, I repeat, just in case if a situation arises like this, that for example, I repeat, just in case the situation arises like this, that for example, you've got a situation which is maybe that year end is 31st December and you have paid contributions into the fund on 30th June. The opening fair value of plan assets was $100,000. The contributions paid are, let's say, $30,000. The interest rate is 10%. Now try to understand this. What is actually going to happen is that you'll have opening fair value as 100,000. The interest calculation would be like this: 100,000 into 10% into 6 upon 12 plus. Now you have made contributions into the fund on the 30th of June. So at 30th of June, these funds will become 130,000. So what is actually going to happen is that if there is an opening fair value of 100,000 and there is an interest which is arising, this is how you are going to account for it. How? Let's just see. So it's actually going to be 11,500. Under the normal circumstances, we just apply 10,000 into the percentage. But here you won't do it this way. You would rather go for what? You would rather go for 100,000 for 6 months, 130,000 for the remaining 6 months. That's how you are going to account for it, and this is how the treatment is going to be. The same approach would be adopted for benefits paid, for the past service costs, for the curtailment. If it in case arises during the year, then you would have to have a time proportionate calculation for the interest. Either it's an interest expense or that be an interest income. You would have to do time proportionate calculations for them. So we are now done with this specific area also. There is one final thing with respect to post-employment benefit accounting, which is the accounting for defined benefit asset, which we are now going to be discussing in our next video. Now there is this one final concept with respect to the defined benefit plans which we need to discuss, and that is termed as defined benefit asset. That is termed as defined benefit asset. What exactly do you mean by defined benefit asset? So for example, if the situation arises like this, if you have got a present value of defined benefit obligation of let's say 100,000 and the plan assets are 120,000, so resultingly you would be in a surplus situation. Normal situation is deficit situation, but you would actually be in a surplus situation. So now let me guide you. If you are in a surplus situation, what is it? It's a defined benefit asset. What is it? It's a defined benefit asset. Should I recognize 20,000? The answer is no. Why? Because IAS 19 provides you a concept which is termed as asset ceiling test. What do you mean by this asset ceiling test? This asset ceiling test would actually mean that the limit, the maximum limit to which the asset could be carried, that's called asset ceiling test. So as per IAS 19, there is a maximum limit to which you can recognize the asset, which is it should be recognized at the lower of what? Lower of amount calculated above. What? See this 20,000, the amount calculated above, or the present value of benefits from reduced contributions or refunds. Now let me explain to you. There are few countries where it is mandatory to deposit X amount of fund into the. There are few countries where it is mandatory to deposit X amount of money into the benefit plans also. Somehow, if the plan performs exceptionally well and there is an excess amount of assets, so those countries can give you relaxation to the amount of contributions. So whatever relaxations that you are getting with respect to amount of contributions, the present value of such relaxations is to be calculated, or if such plans allow for the refund of the excess of the surplus, so whatever refunds that you are going to be getting. So like for example, if the amount calculated above is $20,000 and if it's let's say 14,000 over here, so you're going to be restricting your asset till 14,000. You cannot recognize asset above 14,000. You got to restrict it. So that is what you would have to do. So basically, when you have an asset that arises, you have to put a ceiling. You have to put a ceiling to the asset, and that putting up of the ceiling is going to be termed as asset ceiling, and this is the maximum amount at which the asset could be recognized. The objective of this is to make sure that the assets are not overstated. So we are done with this specific concept also of the defined benefit asset. बस बंद कर दो. Okay, so we are now going to start off some of the examination questions on IAS 19 employee benefits, and one of them is basically the question whose name is Savage Company. Now this is from one of the past examination questions. The requirement is that show the amounts which will be recognized in the SOFP, in the profit and loss account, and in the other comprehensive income of Savage for year ended 31st October 2005 under IAS 19 employee benefits, which was revised in so and so, and the movement in assets and the liabilities in the balance sheet, so and so, so and so. Now see, what information do we have? Let's just see. Let's just try to see. It says Savage, a public limited company, operates a funded defined benefit plan. So it's a defined benefit plan for its employees. Plan provides a pension of 1% of the final salary for each year of service. So you pay 1% into the final salary into the number of years of service. That is what you pay to your employee. So you pay 1% into final salary into number of years of service. This reflects, the cost for the year is determined using projected unit credit method, which is the method used for the actuarial valuation. This reflects the services rendered to the dates of the valuation of the plan and incorporates the actuarial assumptions primarily regarding discount rate, which are based on market yield of high quality corporate bonds. So as per IAS 19, you would remember from the earlier studies that It's the market yield of the high quality corporate bond that we have to use. It says the directors have provided the following information about the defined benefit plan for the current year, the year ended 31st October 2005. Now, the best way to go about with this defined benefit plan accounting is that what ideally you should do is that you should try to do the working simultaneously as soon as the things come your way. So the name of the question is Savage Company, and from the Savage Company we would say present value of defined benefit obligation, and we would say the fair value of the plan assets. So what is it that we are going to do? We are going to say present value of defined benefit obligation and the fair value of plan asset. It says actuarial cost of providing benefits. Actuarial cost of providing benefits in respect of employee services for the year to this was 40 million. This is the present value of the benefits earned. So this is actually the current service cost. What is it? This is actually current service cost. So if I say the current service cost, it is 40 million. The pension benefits paid to the employees in the year were 42 million. So the benefits which have been paid are 42 million. They would reduce the plan obligation and they would also reduce the plan assets. Then it says Savage should have paid contributions to the fund of 28 million. They should have paid. Now, the important thing is that what did they pay? You don't consider what they should have paid because it's a defined benefit plan, it's not a defined contribution plan. So you always consider what they have paid. Because of cash flow problems, 8 million of this amount had not been paid as at the end of the year. So what happens is that you would say the contributions are 28 minus 8 gives you 20. Then it says the present value of the obligation to provide benefits to the current and the former employees was 3,000 million at 31st October and 3375 at 31st October 2005. So what happens is that so you've got 3,000 and you've got 3375. Then there is this fair value of the plan asset which is 2,900 million. And then there is this closing which is 3,170 including the contributions owed by Savage. So as I told you, you don't have to talk about the contributions owed because what has been paid is paid. What is not paid is not paid. Closing plan assets is going to be 3,170 minus 3,170 minus this 8 which has not been paid gives you 3,162. Now it says with effect from 1st November 4, which is the start of the year, the opening date, company had amended the plan so that the employees were now provided with an increased pension entitlement. So this is actually a past service cost. When you pay additional benefits for the prior services, that's a past service cost. The actuaries computed the present value of the cost of these benefits on 1st November to be 125 million. The interest rate on high quality corporate bonds were as follows. So what is it? You would mention the past service cost which is 125 million. Then it says the interest rate at 31st October 4 at 31st October 5. So this is the opening rate and this is the closing rate. Always remember that what would happen is that the unwinding of discount of the expected interest is going to be calculated using the opening rate. So what happens is you would say interest at the rate of opening rate. What is the opening rate here? It's 6%. Multiply by 3,000, and since the amendment was made at the start of the year, so it gives you 187.5. Then there is this remeasurement gain loss. 3000 plus 187.5 plus 125 plus 40 less 42. So up till here it's 3310.5. So it's 64.5 that is going to be recognized here. 64.5 is what is actually going to be recognized over here. And since it's an obligation, and if the obligation increases, it's actually a loss. If the obligation increases, it's actually a loss. So there is actually a loss with respect to the obligation. Now, so 2900 is the opening asset, you multiply it with 6%, gives you 174. There's this remeasurement gain or loss. So how would we do it? 2900 plus 174 less 42 plus 20 gives you 3052. So 110 is actually a gain. It's a gain. 110 is actually a gain. Now let's stop. So when you are gonna be preparing your statement of comprehensive income, so from the perspective of the statement of comprehensive income, you would say for the P&L, for the P&L portion, the current service cost, the current service cost, the past service cost, net interest expense. Current service cost is 40, past service cost is 125. Net interest expense is going to be like this. You'll have 187.5 minus 174. So this actually gives you 13.5. This actually gives you 13.5. Then what happens is that this is something that's going to be recognized in the P&L. So you have 178.5. Then you've got other comprehensive income. For the other comprehensive income, what you would do is that you would say net remeasurement gain or loss. So when I talk about the net remeasurement gain or loss, there is this loss, there is this gain. So you've got 45.5, that's actually a loss. So total comprehensive loss is going to be like this. 133 is the total comprehensive loss. I bet 133 is the total comprehensive loss. So what is it? It's actually 133, that's a total comprehensive loss. When we talk about the SOFP, that how exactly the SOFP presentation is going to be. So you've got the closing defined benefit liability. You've got the closing fair value of plan assets. So I repeat, it's a closing defined benefit obligation, closing fair value of plan assets. So closing defined benefit obligation is going to be what? 3375, 3162. Hence, this is going to be termed as defined benefit liability. Gives you 213 as a defined benefit liability. So I repeat, 213 is going to be the defined benefit liability. That is something that you would be reflecting in the balance sheet. And from the perspective of SOCI, it's going to be 133 that is to be recognized, including the impact of gain in the P&L. So what have we done? We have actually gone through this specific question, the name of which was Savage Company. We now have got this question, the name of which is Smith. From the perspective of Smith, the requirement is calculate the remeasurement gains or losses on pension plan assets and liabilities that will be included in other comprehensive income for the year. Now, in this specific question, I would actually try to guide you people about another way of computing the this defined benefit liability accounting. It says Smith operates a defined benefit pension plan for its employees. At 1st January 2002, the fair value of the pension plan was this, and the present value of the liabilities was this. So what you could do is that you could try to do it on the basis of net liability approach. So from the perspective of the net liability approach, what is going to happen is that this is opening 2.9 million minus 2.6 million gives you 300,000. That's an opening liability. Then what happens is that the actuary estimates the current and the past service cost to be this and this respectively. Past service cost is caused by an increase in the pension liabilities and takes effect from 31st December 2002. So this is actually from the year end. The plan liabilities are correctly reflecting the impact of this increase. So what happens is that net interest expense, the current service cost, the past service cost. The current service cost is 450,000, the past service cost is 90,000. It says the interest rate on a high quality corporate bond was 8%. Okay, so it's 8%. Now what next is there? The next situation is, it says the pension plan paid. Whatever the pension plan paid, that has nothing to do with the entity, it's the pension plan which is settling. So the pension plan paid, it's reducing plan assets, it's reducing plan obligation. So there is actually going to be no impact on the, net assets position or the net liability position. It says on the same date, Smith paid 730,000 in contributions to the pension plan, and this included 90,000 in respect of past service costs. So whatever that is included, all that you have to do is that you have to include the whole amount. The contributions paid is going to be what? The contributions paid is going to be 730,000. Now what next is there? It says at 31st December 2002, the fair value of the pension plan assets was 3.4 million and the plan liabilities was 3.5 million, gives you a closing obligation of 100,000. So what happens is, we would say net remeasurement gain or loss the closing defined benefit liability is going to be 100,000. So what you got to do is that you got to calculate the difference between them. How would you do it? 300 plus 24 plus 450 plus 90. I got to do it again. 300 plus 24 plus 450 plus 90 minus 730. Okay, you've got 134 till here. And this is 100,000. So this is 34,000. Now this has to be a reduction, so it has to be a gain. So hence what happens is that when you are required to calculate the net remeasurement gain or loss, this is what it is. So what did I do? I did not create a separate ledger for the plan assets and for the plan obligation. I just mixed them up, and from the mixing up I actually ended up getting the net liability approach. And from this net liability established net remeasurement gain or loss. Okay guys, so we have in front of us a question from the SBR past papers. The name of the question is Hudson. There are multiple requirements to this question which we need to see. One of them is explain why the directors of Hudson are wrong to classify the basic settlement and additional pension contributions as part of the remeasurement component, including an explanation of the correct treatment for each of these items. Also explain how other restructuring costs should be accounted for. So that's one of them, which is about the IAS 19. employee benefits. Second, it says, explain why a deferred tax asset can be recognized in the financial statements of Hudson in the year ended 31st December 2002. Identify any ethical issues which will arise from the director's proposed treatment and the behavior. Your answer should also consider the implications for accountant arising from the director's behavior. So there is this ethical issue also that actually needs to be covered up. Now let's just try to see what is actually going on. It says Hudson has a year end of 31st December 2002 and operates a defined benefit scheme for all employees. For all employees. In addition, the directors of Hudson are paid an annual bonus depending upon the earnings before interest and tax, depreciation and amortization of Hudson. So basically what happens is that the directors, there is a defined benefit scheme for all employees, plus the directors are also being given a bonus on the basis of EBITDA. On the basis of EBITDA. Hudson has been experiencing losses for a number of years. So you have been experiencing losses for a number of years, and its draft financials reflect a small loss for the current year of $10 million. So you do have a loss in the current year also, and that is of this $10 million. Now, it says on 1st May 2002, Hudson announced that it was restructuring and that it was going to close down Division Y. Okay, so there is a division that they are planning to close down, and when is it that they announced? On 1st May 2002. A number of redundancies were confirmed as part of the closure, with some staff being reallocated to other divisions within the Hudson. So there is going to be some staff that is going to be reallocated, and there is going to be some staff which is going to be removed. Right now, it says the directors have approved the restructuring in a formal directors meeting. Hudson is highly geared. Hudson is highly geared, and much of its debt is secured on covenants. Much of its debt is secured on covenants. So it's a highly geared company. That means it's at a risk, which stipulates minimum level of net assets should be maintained. Okay. So the problem is that the minimum level of net assets are required to be maintained. Now you see, one of them is the bonus of the directors is linked to the earning before interest, tax, depreciation, amortization. And what happens is that the debt covenant is on the basis of net assets. The debt covenant is on the basis of net assets. Now let's just see. It says the directors are concerned that compliance with IFRS could have significant implications for the bonus and debt covenants. So what is happening is that the directors are concerned that the compliance with IFRS can have significant implications on their bonuses and the debt covenant. So that means both of them are going to be missed out or breached, or you could say. Now, redundancy and settlement costs. Hudson still requires number of staff to operate Division Y until it is final expected closure in early 2003. So that means the closure is going to happen, but they do need some staff to stay back till the time this department gets closed. As a consequence, Hudson offered its staff 2 settlement packages. Okay, what are they? In relation to curtailment of the defined benefit scheme, okay, a basic settlement was offered for all staff who leave before final closure of Division Y. So when you've got a basic settlement, so that is for all the staff who leave before the final division of Y. An additional pension contribution was offered for staff who remained in employment until the final closure of the Division Y. Additional. So when you give an additional pension contribution, that's something else, and when you close it, that is something else. This is considered to be the curtailment, and this is considered to be the past service costs. I'm going to discuss about them more. It says directors of Hudson have only included an adjustment in the financial statements for those staff who left prior to 31st December 2002. The directors have only included an adjustment in the financials for those staff who left prior to 31st December 2. Directors have included this adjustment within the remeasurement component. Okay, so what have they done? They have included this within the remeasurement component of the defined benefit scheme. They do not wish to provide for any other settlement contributions until employment is finally terminated, arguing that an obligation would only arise once staff are made redundant. So what are they saying? They say that the obligation would only arise once the staff are made redundant. On final termination, the directors tend to include the remaining basic settlement and the additional pension contribution within the remeasurement component. So upon the final settlement, they want to include that within the remeasurement component. Directors and accountants are aware that the proposed treatment does not conform to Okay, so you see how big a doubt is there on their integrity. They know that it does not comply with IFRS, still they are going ahead with it. Now, it says directors and accountants are aware that proposed treatment does not conform to the IFRS. Directors believe that proposed treatment is justified as it will help Hudson maintain its debt covenant obligations and will therefore be in the best interest of their shareholders, who are the primary stakeholders. The directors have indicated that should the accountant not agree with their accounting treatment, then he will be replaced. Okay, so there is an intimidation threat for the accountant also. So what is he going to do? He is being intimidated that look, you got to make sure that you don't comply with the IFRS. If you are going to comply with the IFRS, then make sure you are going to be replaced. So we're going to be talking about the ethical issues as we move forward, but right now let's just talk about the few things with respect to how it should be accounted for and etc. Now see, what happens is when we talk about the defined benefit plan, what happens with respect to the defined benefit plan is that there are two important things that you need to understand. In fact, three things. Curtailment, past service cost, and remeasurement gain loss. So I repeat, there are these three things that you got to understand with respect to the defined benefit plan before you do this scenario. One of them is a curtailment. What is this curtailment? The curtailment is actually the reduction in number of employees covered by a plan. So if you've got a plan and if you reduce the number of employees who are going to be covered by the plan, that is going to be considered as curtailment. When we talk about the past service cost, the past service cost is the increase or decrease in benefits payable for the prior period services arising in current period. And then you have got the remeasurement gain loss. And what exactly is this remeasurement gain loss? The remeasurement gain loss is basically it's a actuarial gain loss. It's an expected return differences. That is what it is. Now, The curtailment is required to be recognized in the P&L. The past service cost is required to be recognized in the P&L, and this is required to be recognized in the OCI. Basically what happens is that under the current situation, I repeat, under the current situation, what is actually going on? Under the current situation, one of them is a basic settlement, and one of them is a basic settlement and the other one of them is an additional contribution. They're both two different types of benefits that are being given. If you look at this scenario, you would see that the basic settlement, I repeat, if you would look at this scenario, you would see that the basic settlement is actually what? The basic settlement is a sort of curtailment that has taken place. The basic is actually a sort of curtailment that has taken place. And when it comes to this additional contribution, this is the past service cost. Because you're going to end up paying additional benefits to those who stay with you till the termination or till the closure of the division. So if you are removing people right now, so this is something that's a curtailment, and you got to recognize the curtailment in the P&L. You cannot classify this as a remeasurement gain loss. It's not remeasurement, it's a decision that you have taken. Plus the additional contribution for the services that have been provided, that's a past service cost. That is also required to be recorded in the P&L. That cannot be booked in the OCI. The remeasurement gain / loss would contain what? Actuarial gains loss, the interest rate changes, that is what it is. And the actuarial gain or loss is what the actuary said that you would require to be paying 40 million, but you ended up paying 50 million. So this goes to OCI, the 10 million, because you don't want to keep the financial statement fluctuating because of the errors in the actuarial valuation or because of the changes in the circumstances. You don't have to get the financial fluctuating again and again. So for that, what you do is that you don't go for the actuarial gain and losses to be recognized in the P&L. Instead, you recognize it within the OCI under the head of remeasurement gain loss. You expected the interest rate to be 9%. They turned out to be 7%. There is a difference in the interest expected to be recorded as income, and there is a difference in the interest that is recorded as income. So that difference is also recorded in OCI, not in the P&L. Now try to understand something. Basically what is going to happen is that, I repeat, what is actually going to happen now is that on the basis of all this, I repeat, on the basis of all this, what is actually going to happen is that you need to tell them that, look, you cannot recognize everything in the OCI. You cannot classify everything into the remeasurement gain loss. So we need to see, in accordance with IAS 37, if the constructive obligation to restructure exists or not. So in accordance with IAS 37, it says the constructive obligation, you need to recognize the provision for restructuring when the constructive obligation to restructure exists. What is that constructive obligation to restructure? That constructive obligation to restructure is that there has to be a plan which contains a lot of things like number of employees expected to be covered, the locations that are going to be affected, etc. So apparently there seems to be a plan. And what happens is that in addition to having a plan, there is one more thing, which is announcement, which has also been made. So the public announcement has been made. People are being told, people know that there is something that's going to happen. And again, what is actually happening over here is that the constructive obligation to restructure does exist. Now see, if the constructive obligation to restructure does exist, so what happens is that the provision is required to be recognized in this scenario. The provision is required to be recognized in this scenario. Now, if the provision is required to be recognized in this scenario, then what happens now? Let's try to understand. Then what happens now is that what you got to do, you got to say that the gain or loss on curtailment shall be recognized in the P&L. Provision for restructuring to be recognized. Provision for restructuring to be recognized. Furthermore, the additional benefits to be treated as past, additional benefits to be treated as past service costs. And it is also to be recognized in the P&L. That is something. Now, all other gains and losses could be recognized in the OCI under the head of remeasurement gain loss. So that is how you will be accounting for it. So always remember, you are laying off employee, that's curtailment. The gain or loss on curtailment has to be recognized in the gain or loss on the curtailment has to be recognized within the P&L. You are increasing the benefits payable. That's a past service cost. It has to be recognized in the P&L. There is a remeasurement. The remeasurement is going to be taken to OCI. That's how things are going to be. So that was basically the first part of the question, which was about the Hudson company's remeasurement gains and losses with respect to the post-employment benefit scheme.